Great. So next question, can we review the risk range product, please? And this really wasn't a question that I pulled, but I have gotten a lot of questions in generally about about the risk range product. And I think there's some confusion at times around risk ranges. And so I just really kind of want to spend a few minutes clarifying the use of this product. All right. So, um, yeah. So the key thing here from the ranges is to me the way I review them. Hence why I've talked a lot about higher lows and kind of lower lows and convert. Just the directional moves of the risk ranges. It's really all about the rate of change, right? So I know many within the Hedgeye Nation transcribe the risk ranges into either Excel or charts or something like that. And I think that can be very helpful, especially from a visualization standpoint. However, what I will say to that is that you're kind of taking dynamic ranges and making them and converting them to like static points on a board, right? So I would, it's not really caution against it. It's just be cognizant, right? So it's not really caution. It's be cognizant of what you're transcribing, what you're doing, right? So when you just put those points on a graph or on a chart, you're taking dynamic ranges and making them static. And so, to me, the more important thing to do would be to track the rate of change and note the directional moves of the top end and low end of those ranges. Is a very worthwhile endeavor, especially on a day over day and week over week basis. That's kind of how I typically look at them, because if realistically, if you go much more than, week over week on a trade duration, so on the immediate term duration risk range, which we get every day, I think they probably become a little stale, or there's just like nuance. Obviously, you can still reference them, but you got to be cognizant of kind of like what the where price volume volatility is. So, additionally, again, I'm just going to reiterate this. I've said a couple times already today, but the risk ranges are influenced and are built on price, volume, and volatility. And so, the price and those the closing price, excuse me, is what influences the top and low end of the risk range alongside the price, the volume, and volatility. So really taking a note and making sure you're aware, especially during the day as the day kind of trades and that kind of thing, where that closing price was, and having an idea of where the top and bottom end of the risk range are, can help you understand, like, if price is moving higher, the ranges will likely dynamically kind of move higher as well, incrementally, right? So if price is moving higher above where it closed yesterday, that top and low end of the risk range are kind of like move a little bit in sync with it as well, right? So it's not like a perfect correlation, obviously, because it's a dynamic range. But I think just visualizing and understanding, because many have, and I struggled with this when I first sort of started doing things as well, is sort of executing at the top of the risk range, but not really factoring in the price, volume, and kind of volatility, and specifically the vol of that specific asset class. But similarly, if the vol for that piece of inventory moves significantly in either direction, right? So if you kind of look at realized volatility, or just, you could probably use VIX as an example, or that kind of thing, right? But if it moves significantly in either direction, that's also going to influence the width of the range, right? So basically how wide or narrow it might be. So again, the volatility, typically what I've heard Keith mention and say over the course of since really joining Hedgeye is a kind of consolidating risk range. Consolidating risk range means kind of volatility is shrinking, or kind of as reducing, is coming out of that asset. And then, when the range is expanding or widening, volatility, there's like kind of higher volatility there. So higher volatility can be a good thing, in terms of if price is going up on volume, and kind of, volatility, kind of helps beget that price momentum higher. But generally, kind of, if you're writing down the risk ranges and you see the range like shrinking in size, aka the numbers getting closer on the page, then that volatility is coming out of that asset, right, out of that piece of inventory. And oftentimes, just money or flows like to flow towards assets that have decreasing levels of volatility. That's a positive. Usually, that's where, gold, for instance, still down at at around 15 on the GVZ, OVX at 35, right? So that's down almost 8.3% in the last month, down 316 basis points, right? In terms of OVX over, on a month over month basis. Yeah, that helps kind of, even though it's bearish trend in terms of just oil or WTI, that decreasing volatility inside of oil can help attract, asset flows to that particular piece of inventory. So all of that together kind of is quite important to kind of understand and review as you're kind of looking and writing down and reviewing kind of the risk ranges, right? So so just want to kind of highlight and Celts, if we can pull up slide 12 there. I've got the day over day comparison. So this is this morning's risk range on the left versus the yesterday's risk range on the right. So again, just kind of want to highlight some things there. You've got the 30-year, 10-year. So when I mentioned on the 2-year a few moments ago that it was a big higher low, what I mean there is that the low end of the yield is from a math standpoint is today is 4.34 versus yesterday at 4.29. So that's a big higher low, and same thing on it's a higher high too at 4.72 versus 4.70 yesterday. And similarly, if we kind of go down the page, I mentioned XLK earlier as well when we are doing that example at 144 on the top end of the range today versus 145. So that's a slightly lower high. And a bit of a higher low as well on the low end of the range at 134 versus 133. So again, these are all important things to do. XLU went bearish a few weeks ago, and you've got you've got the low end of the risk range at making lower lows, and the top end of the risk range making lower highs as well. So you got 66.27 on the low end versus 66.30 yesterday, and then 69.16 versus 69.33. So again, these are all really important kind of things to review and understand as you're doing as you kind of writing down and reviewing your risk ranges and that kind of stuff. Similarly, even though GDX remains bullish trend in terms of if you do subscribe to the Macro Pro product, you'd see Keith has been kind of he has been adding to that position much in the last kind of 2 weeks. And I would say a key thing here to be watching on certainly a day over day basis is that it's making lower highs and putting in lower lows as well. And you can see that on the right here there at 3104 versus 31.70 yesterday, and 28.25 on the low end versus 28.52 on the low end yesterday. So again, those are signals where price momentum is sort of like declining. So it's still bullish trend because the trend level is lower than that. I don't have it off the top of my head. I should have written it down, or I do have it written down somewhere in here. But that trend level is below where the price is currently. So it's still bullish trend, but basically the signal strength is getting a little bit is not quite as strong as it had been leading into the end of the month of January, right, on this recent pullback. So what you'd want to see there is a higher low on the bottom side, and then really either consolidation of that range where volatility is basically coming out of that asset, or also a higher high. So kind of like a higher low and a higher high being put in. That would be your first sort of inclination to kind of re-enter or get back into or expand your kind of position size inside of GDX. Now, if we go back to if we go to the next slide there, I'm sorry, Zelts. This is going to be the week over week comparison, and again, I review things day over day just to get an understanding as to what's transpiring. Just as I said, kind of on a day over day basis, but on a week over week, you can really get a bit more of the kind of bigger picture, right? Like where have we come? So last Friday, GDX, just to kind of keep going on that example, I had a top end of the risk range at 33.11, whereas today it's 31.04. So that's a big lower high. And same thing with the low end at 29.02 last Friday at 28.25. So that's a lower low as well. So again, just kind of like reviewing things on a week over week and a day over day basis. I'm not going to run through everything here because I think you get the point. I guess the other big call out would be as well in terms of the week over week basis. On a week over week basis, your U.S. Treasury 30-year and 10-year have moved from neutral to bullish. So it also helps kind of just review and make sure, hey, these things move neutral. Are there any positions inside the portfolio. Maybe you can't touch things every day and that kind of stuff, but making a note and capturing and reviewing kind of big moves or big changes, aka when signals shift, especially in terms of the 10 and 30 year here from neutral to bullish, that has a direct inverse correlation to being long TLT or IEF. And you saw us boot both of those out of ETF Pro earlier this week and late last week. So again, these are big things to be noticing. That's how you can leverage the risk range product to help influence the portfolio positions inside of your portfolio and making decisions therein as well.